Hello everyone, my name is Kamal Manocha. Another very interesting webinar that we have planned for today. It's about fractional investing, which gradually is becoming a very popular concept. It's already a popular and well-known concept in the West, but in India it's catching up as more and more affluent investors are wanting to invest the way HNIs have been investing over the last 2 decades. Fractional investing, is becoming popular. And to begin with, fractional investing has already seen a lot of players coming up in the real estate space. And how fractional investing actually, works in the commercial real estate space, and how one should be actually doing commercial real estate in the new age environment is what Myre Capital is trying to change, is trying to write. Today we have the founder and CEO of Myre Capital. Myre stands for Myre Real Estate. Aryaman is the founder and CEO. Brings with him a very, I would say, decent experience of having created this entire platform and having done a lot of meaningful deals. He brings with him a qualification in Bachelor's of Science and Master's of Science from University of Pennsylvania. And very interesting is that he has done MBA in he has done his Master's from Wharton Business School with specialization in real estate, which I was not aware of, that Wharton does offer such specialization also. So this is very interesting, and the presentation that he has is very meaningful. I have gone through this presentation, and it's interesting to go through some of the slides, and that is where I think I should not hold more, and I will hand over the entire platform to Aryaman for him to actually take us through his thoughts on how Myre Capital is redefining the way India should be investing in real estate. Over to you, Aryaman.
Thanks, Kamal, for the introduction. I'll just start by sharing the presentation. Great. So thank you everyone for joining us. And I think Kamal gave a great introduction. I'll just add a little bit to it. So, Myre Capital, we started with an idea where we want to change how India is investing in real estate. We've seen two primary trends, which, we are on a mission to change. The first being that a lot of your commercial real estate has been invested into only by institutional investors. So, there's a lot of foreign capital that has come into the country, and we're seeing a lot of foreign stakeholders in our real estate. So the amount of Indian participation, especially from retail investors, has been negligible in this space. The second trend that we noticed is that people who have, let's say, 1 crore to deploy or 2 crores to deploy, they don't end up buying A-grade assets. They go to apartments, they go to small shops, and those are highly unstable. So, in an attempt to diversify into real estate, quite often people end up burning their hands, and that's the sentiment that we are trying to change in a more structured approach. So I'll touch upon a lot of these points in more depth through the presentation. But starting off, I'll give an introduction to Myre Capital. So Myre in itself is part of a larger group organization. The parent firm is Morphogenesis. Just to give context, Morphogenesis today is the largest architecture practice in the country. So in terms of pedigree, we understand not only how real estate operates post-construction, but also how real estate is built ground up. So, that gives us insight into the intrinsic value of an asset, enables us to select better assets, for our investor base. So why is commercial real estate such a strong proposition, and, why have institutional investors gravitated to Indian commercial real estate? The answer to that is twofold. So one is that, like a lot of debt products, this gives you a fixed monthly income in the form of a rental. Those rentals are quite often benchmarked at 8%, 9%, and they are linked to inflation, so they escalate with time. The second part to it is that unlike debt, more in line with equity, you have a capital appreciation component. So this the dual return profile of the asset class has made it very appealing to institutional investors. More importantly, you get an underlying asset. So you have a hard asset, being commercial real estate in this case, to protect your downside risk. So, even in the last few years of the pandemic, we've seen A-grade commercial real estate has remained relatively stable. That was the basic vision of bringing this entire asset class at a smaller ticket size, eroding the traditional barriers to entry, for investors, and effectively increasing the proportion of participation of retail investors in this asset class. Now, just a quick few things about Myre Capital. So, in terms of our AUM that we've secured in the last 1 year, we've done assets of more than 150 crores. Again, we only enable investors, or well, the minimum ticket size, on our platform is about 25 lakh rupees. So, we have a multitude of investors from a very diverse background, NRIs, salaried professionals. All of these people come together. We enable them to form a consortium and go out and purchase a very marquee property. All our properties which are listed on our platform are rent yielding. We serve as the asset manager. So to that extent, we've seen a lot of growth and demand for such a investment product. The group organization, including Myre, has extensive experience of 25 plus years. We've done projects in 8 different countries, 50 different locations, again in different capacities. We've been recognized, on various occasions for the kind of things we're trying to do. Most recently, we won, the PropTech Platform of the Year award from Realty Plus. Again, all of this, just helps add to the entire awareness we're trying to raise for this kind of model. And just to take a step back, so fractionalization is effectively what we're trying to do of commercial real estate. And this concept of fractionalization is one that has already come into other asset classes. So, when you look at equities, owning a share of a company is effectively fractionalization. In debt, again, you're fractionalizing debt when you're taking a part of a loan. So, to that extent, commercial real estate, we are trying to fractionalize in a similar manner, enable people to participate at a much lower ticket size. Now, going forward, I've touched upon quite a few of these benefits already, but what we'll start by doing is benchmarking how commercial real estate stacks up to the other asset classes. So again, what we always emphasize is we're not saying equity is better than debt or debt is better than real estate. What we're effectively saying is that a comprehensive portfolio entails, diverse asset classes, of which one is real estate. Now, as a tendency of Indians or preference of Indians, Indians really like rental income. Indians gravitate towards real estate. So we are trying to create a streamlined solution for them to get that rental income, for them to get that capital appreciation in a safe and structured manner. So overall, some of these points we've discussed, you get a monthly rental income, which is very attractive today of 8 to 10%. When you benchmark that against your debt rates or your FD rates, this is considerably higher. Now, compounded to the rental yield, you also have capital appreciation. So quite often in India, the appreciation in, as a basic rule of thumb has sort of been linked to inflation. So we've seen about 4 to 5% sustained growth. Now, of course, you have micro markets which perform better than the average and some that don't perform as well. But, overall, what one can expect to make in terms of an IRR is, 13 to 20% depending on the proposition. Again, capital preservation. So this is something very important, something which has become, increasingly important, in a post-pandemic world. Real estate, again, being a hard asset, it has a downside protection to it. So, in most cities, the government has enforced a guidance value, ready reckoner rate, or its equivalent, whereby they've set the threshold below which the property cannot transact. So, that sets a baseline to give that capital preservation aspect. Again, this is a stable and non-correlated asset class. Now, just to put that into context, equities are something which are highly speculative. Debt, again, is impacted by your credit risk. Real estate, on the other hand, your flow of income is actually from tenancy. So even in the pandemic, what we witnessed is the A-grade tenants, MNC tenants, who had that brand associated with the location of the office. They didn't vacate. We've maintained 100% rental collection distribution rate. So overall, it's a good avenue to hedge against other risks in other asset classes. So the 2 points at the bottom of the slide. So this is just reiterating the fact of its entire return profile being similar to debt in terms of fixed income, as well as equity in terms of your double-digit IRRs. So these are some snippets of how commercial real estate has, bounced back in a post-pandemic world. We are seeing record leasing. In fact, just prior we began this webinar, I was discussing, with the team, the uptake in leasing. So what we witnessed in the last 2 weeks is effectively the backlog of the previous 3 years in which leasing was subdued. So a lot of that is coming back. Vacancies have again dropped to single digits, if not lower. We are seeing MNC tenants like IBM, Deloitte, Accenture, significantly ramp up their office space consumption. Interesting thing that has been that you can see the silver lining of the impact of the pandemic on real estate is that the area that a company was allocating per employee in office space has gone up by 20 to 30%. So just to put that in perspective, pre-pandemic, an employee was basically being allocated about 40 to 50 square foot. Today, in a post-pandemic world, most MNCs have mandates to increase that to about 70 to 80 square foot, per employee. So what that effectively is doing is consuming more real estate in terms of, office space. Some other interesting trends that we witnessed in the pandemic was that, yes, whilst retail perception of work from home was quite significant, the counter side was that institutional investors continued to pick up distressed deals. They continued to identify assets that were, under market in terms of value, and we saw $1.3 billion, of inflow only in a quarter of 2021. Again, this is a record quarter, and 2021 was a pandemic year. So, these institutional investors have understood that, Indian real estate is a stable avenue, plus the underlying fundamentals was something that did not change because of the pandemic. So you did have temporary impact, but that did give room to a lot of A+ grade assets becoming available to investors that did have the capital. So we are trying to secure such investments for our investors and effectively position institutional grade opportunities to them. Now I'll start off by discussing, what the problems are with real estate investing with respect to an individual investor trying to go out and, acquire a A-grade property. So a lot of these large floor plates that you are seeing, in the REITs, in institutional developments, usually to acquire any stock in those premises, you have to shell out 30 crores, 50 crores, sometimes upwards of 100 crores. Now, traditionally, that is the main reason why this space has been dominated by institutional funds only with limited retail participation. But another model that we saw that was popular was that, friends and families came together, made a consortium, and then went out and bought properties. So we are trying to take that consortium model a step forward. Now, every investor does not have the capability to go out and find his own consortium. So as Myre Capital, what we are trying to do is get like-minded individuals together, give them a consortium. We become the managing framework so that there's no discrepancy during the whole investment period. And effectively, this enables us to reduce the ticket size which each investor has to contribute. So a very interesting outcome of it is that rather than having 50 crores, 60 crores deployed into a single property, via our platform, one can also diversify. So, they can choose to put, let's say, 2 crores in a property. They can choose to put 50 lakhs in our next one. Thereby giving a very comprehensive portfolio. Another aspect which is a problem in real estate for HNI especially is the property management aspect. Now, quite often, HNIs go out and buy floor plates of 50 crores, but then they struggle to lease it, maintain it, manage their tenant, manage the facility, and eventually their costs tend to go up, which, negatively impacts their returns overall. As a platform, Myre Capital, we provide that entire asset management aspect to all our opportunities. So, everything that is listed on our platform, we do end-to-end management of. So, all the way from identifying the asset, negotiating, legal diligence, after the investment, doing reporting, rental collection. So, all of that aspect is done by us. So, for an investor on our platform, it's as easy as investing in a mutual fund. Within a few minutes, they can complete their KYC, they can go through all the details of the property and confirm their investments. So we are trying to move real estate investing from a traditionally physical process to a more digital process, enabling people to do this, from the comfort of their homes. Now, a part which is often overlooked is tenant relations. So tenant relations is something which really enables a property to be stable in terms of your rental income. These are something, tenant relation is something which one cannot build overnight. It's not something that one can do whilst running another business. So as Myre Capital, we have a very strong tenant relations team. We constantly are working with tenants to understand what is their requirement, because at the end of the day, we try to build a fine balance between ensuring our investors are happy and ensuring the tenant is happy. Thereby, the overall equation gives a very stable proposition to our investors. So liquidity, again, this is a huge challenge which has been in real estate. So usually to get liquidity in real estate, you've traditionally had to exit the entire property, which means finding a buyer for 50 crores or 70 crores, onward, which is not an easy task. In our case, what we do is that, interim liquidity is possible. So if an investor, let's say, wants to exit after 1 year, because it's in a fractional format, it's much easier to find a replacement buyer for him for, let's say, 50 lakhs or 1 crore of his investment. Property sourcing. So this again is something that we've developed a very proprietary process for. So we use a lot of tech to identify assets and evaluate them in real time. So, we evaluate these assets across 150 data points. We've developed automated algorithms. What this enables us to do is understand the micro market from a more quantifiable perspective. Traditionally, the way people have gone about identifying properties is based on, you can say, gut instinct, or based on, subjective parameters. But, we believe that to truly derive that appreciation value, it's important to understand what the intrinsic value is and what the market value is. So, we take all of that into account and do our analysis. So these are some of the points that we did discuss in the previous slide in terms of what is the solution Myre Capital is offering, but I'll cover all of them again in a nutshell. The low barrier to entry. So this is our solution for the high capital cost which has traditionally been associated with real estate. On our platform, you can access the exact same investment opportunities, the A-grade ones, only from a 25 lakh rupee minimum. So your returns are still commensurate of an investment at a higher ticket size, but of course your exposure to a particular asset has been minimized to only 25 lakhs. In terms of expertise, again, the architecture practice along with Myre Capital's asset management capabilities, we've got a lot of recognition not only in India but also internationally. Skin in the game. So, this is something which resonates with our philosophy. We strongly believe in our asset selection process, and hence we participate in each opportunity ourselves. So, our approach is that if a property is not good enough for us to invest in, then it's not fair to recommend it to our investors also. So, to that end, through the tenure of this investment, we are alongside you not only as your asset manager but also as a co-investor. Again, so the whole process is data-driven, digital-based. 150 plus data points we evaluate every building across, all the way from solar insulation, building quality, construction quality, long-term durability. How the building will age with time. Will the utility expenses go up? Will the maintenance expenses go up? So all of that we factor in, we discount to today, and this is very important to do to understand what your future liability might be with respect to a property. So the entire management aspect, we provide from leasing, maintenance, accounting, taxation, tenancy, everything end to end. Transparency again is one of the cornerstones of Myre Capital. So we have a investor dashboard, again something which is tech driven and updated in real time. So in any of our properties, let's assume we do a single rupee of expense or there's a single rupee of revenue. Or for that matter, let's say there's a agreement with a tenant. Everything is provided transparently on our investor dashboard for investors to see. So there's no ambiguity with regards to cash flow or fund flow or returns. So convenience. So again, one can complete his investment on our platform few minutes and entirely digitally. Going forward, so the property selection aspect I'll spend a minute on because this is very important, especially when entering real estate as an asset class. Now, one thing that we heard as a common feedback prior starting Myre Capital was that individuals either said that they made a lot of money in real estate or they said that they burnt their hands in real estate. There was no middle ground. So when we went more in depth into this, thesis, what we realized is that because of a lot of data asymmetry, one does not know exactly what the right price is to buy a property unless he has a full system or in-house capability to evaluate the same. So what we basically do is that on behalf of all investors, we are doing this in real time. As you can see, at any point in time, we have 100 million plus square feet of deals which have been sourced. So we work with all your IPCs, we work with developers, we work with corporate tenants. So recently we are trying to do a deal with one of the leading telecommunication companies in the country where they're gonna sell us their office space and then become long-term tenants for us. So we keep coming up with these creative structures to get off-market deals for our investors. We try to minimize the qualitative aspect of the asset selection process and emphasize the quantitative evaluation. So we use a lot of AI, ML algorithms, big data insights, and effectively, shortlist the cream of the crop. Once we shortlist properties, then we take it a step further. We go there, we do our structural analysis, legal diligence. We go the entire journey with respect to the evaluation. What comes out at the end of it is only 1% of properties. So because there's so many variable factors when you're evaluating an asset, your conversion rate, or you can say your selection rate, is under 1%. So this kind of scrutiny, this kind of stringent asset selection criteria is very important to ensure that you are accessing real estate in the correct and safe manner. So a little bit about our listing and platform. So again, these are some of the opportunities that we've already funded in the last few months. The yields on these opportunities usually are 8 to 10%. Now, what we focused on during the last year because of the pandemic was very stable and secure assets. So all our offerings have fresh leases. So these tenants are cognizant of the fact of what's happened in the past few years, yet they are willing and moving forward with their lease agreements. All our lease agreements are very long term. So we don't do 1 year leases, we don't do 3 year leases. We do 9 years to 15 years. So thereby we have long-term stability with respect to cash flow. Another interesting part about this is that we usually require our tenant to do the interior fit out. So, interior fit outs can cost, they do cost 3,000 rupees a square foot on average. Properties are, roughly we are acquiring ITS properties are 8,000 to 10,000 rupees. So, 30% of the capex is being invested by the tenant, which increases the stickiness to the premises. So all of those things being put together, give this sort of return profile where we are aiming for 13% to 20% IRRs, where we have MNC blue chip tenants only giving us a rental yield of 8% to 10%. Some of the tenants that we recently, secured in our portfolio include the RBI. It includes tenants like Bentley Systems, which recently IPO'd as well, and we have some really flagship tenants that we are working with for our next couple of opportunities. Now, in terms of the overall proposition, this enables you to diversify. You can optimize tax in your on your own hands. So this enables you to understand what the tax outflow will be, and these are all stable assets. So ones which you don't have vacancy risk, you don't have leasing risk, you don't have execution or development risk. These are completed institutional grade developments. Other landlords in these developments usually include insurance funds. They include your Blackstone, Brookfield. These are the other kinds of investors who come into such premises. And yeah, sorry, I actually missed this out. So as you can see, Maker Max City, 9.2% yield. We had Magarpatta 1, which was one of the most successful projects we did. At 8.8%. In fact, this was in lockdown 1. So this was a time when people were still skeptical of office space, but we used that to our advantage to secure a very, very secure, very, very attractive capital value. And some investors recognized that and took advantage of it. So I'll go a little bit into the tech aspect as well as what our platform is. So there are three proprietary parts of our platform that enables a more enhanced liquidity option with respect to this entire investment. So first and foremost, we have an online secondary market. So, like your debt products or like NCDs, MLDs, we enable people to transact on a secondary market. Now to put things in perspective, currently we have a user base of more than 15,000 users, and we are growing at a rate of more than 3,000 users a month. So to liquidate, let's say 50 lakhs or 75 lakhs in a single opportunity, it usually doesn't take us more than a few days. But more importantly, most of our opportunities are usually oversubscribed. So our previous one that we did in Mumbai got oversubscribed by 1.8x. So more often than not, the people in the wait list or the people who've already invested in the opportunity tend to provide that liquidity to anyone who wants to exit for whatever reasons. We allow private transactions. So in case you identify a buyer for yourself and you want us to transact the fractional ownership to that new buyer, then we simply facilitate that. Most importantly, we constantly evaluate the market conditions and identify optimal asset exit opportunities. So asset exit refers to the situation in which we exit the entire property and give investors, the principal plus capital appreciation back at an optimal capital value. So this is a little bit about what we did in the last 12 months, despite the two pandemic-related lockdowns. We aggregated more than 100 crores of AUM. So the cities that we identified and launched opportunities in were Delhi, Mumbai, Pune, and Bangalore. Some of the tenants in our portfolio that we secured this year include DHR Global, Bentley Systems, AppDirect, SmartWorks, Iftars, which is RBI subsidiary, and now Grow. So again, all these tenants, we do in-depth financial analysis. We evaluate their stability in black swan events such as the pandemic, and all these tenants, in fact, came out stronger, if not, entirely profitable, even in the post-pandemic world. A very important point to be noted over here is that as a platform, we've been able to secure 100% rental collection rate. Again, in the 3 lockdowns, and investors have got exactly what we projected, if not higher. There was no discounting in rental, there was no leeway given to any tenant for that matter. In a few slides, I'm just going to share an overview of our current opportunity, which is the Vaishnavi Tech Park. Again, something we are very, very excited about. In fact, this kind of asset quality we haven't previously got access to. In fact, and most HNIs wouldn't. This is a development which got a lot of institutional traction, but because of certain requirements of the developer, whereby he wanted to retain stake in the building itself, institutional funds were unable to close the transaction. So usually when an institutional buyer comes in, they want to buy the entire park. But in this case, because the developer himself saw a lot of appreciation value, he wanted to retain a significant proportion of it. So, we got a very good entry point. We got an opportunity that is otherwise off market. And as a development, Vaishnavi Tech Park is something which has become very, very famous in Bangalore. I'll start by talking a little bit about the park itself, and then we'll move on to the other details. So Vaishnavi Tech Park is a brand new building. It has 8 lakh square feet of office space, and that center building you see, that's entirely retail. The building has been certified as IGBC Platinum. So a platinum rated building is very rare to come across, especially for an investor. No one sells a platinum rated building. And just to put that in context, each city has maybe a handful. So Delhi has maybe 1 or 2 buildings. Mumbai, I think, has only 1 building. So to that end, owning a platinum rated asset in itself is a very exciting aspect of this opportunity. Now, despite this being a newly constructed opportunity, 100% of the tower that we are acquiring in has been leased out in a couple of days. So tenants are still appreciating high quality developments, high quality workspaces, and in fact, in the transitioning back to office, they've emphasized these kinds of parameters which focus on work quality and things like that. Some of the tenants that have come into Vaishnavi Tech Park include your Discovery Channel, Aukwin Financial. Aukwin is a NYSE listed entity, and of course Grow, which is the anchor tenant in this building. So this entire premises has actually, the management is being done by SmartWorks. So SmartWorks is the leader in managed leasing. Now I'll just take a step back and explain what managed leasing is. So something that came out as a trend in a post-pandemic world is that tenants wanted to have lesser capex outflow when they took office spaces. So SmartWorks as a solution provides, turnkey interiors to these tenants and amortize the expense across 5 years. So what this does for an investor like us, who is the landlord, it gives us a dual layer of security. So we initially sign an agreement with SmartWorks where they assure us, certain rental. Now that rental, irrespective if they have a subtenant or not, or if they've been able to further lease out or not, is guaranteed to the landlord and secured with a registered lease agreement, which is a legal document. So overall, the proposition is very safe and stable, especially given the dual, security of rental cash flow. SmartWorks as an organization and as a business model, their revenue grew by 3x in the pandemic. The area they're currently managing, when we made the deck was 4 million square feet. Today I was speaking to management of SmartWorks for a few reasons, and they informed me that this has gone up to 6 million square feet. What is unique about SmartWorks is that they don't do speculative leasing. They currently have a 90% plus sub-tenancy rate, so highly profitable. They're the only flex space provider that has become profitable, and a very important distinction from other operators like WeWork, IndiCube, is that SmartWorks only works with enterprise clientele. So they don't work with small startups. They don't work with individuals. SmartWorks only works with the likes of Amazon, Microsoft, RBI, and in this case Grow, tenants like that on long-term leases and long-term contracts. In this case, our subtenant is Grow. So Grow has already come in. SmartWorks has secured their leasing. They've taken a very, very long-term contract, which we'll come to in a moment. Grow doesn't need an introduction, but I'll just spend a minute on it. Grow as a company basically operates one of the most successful digital mutual fund and stock platforms. As a business model, this is something that is not impacted by black swan events. In fact, in times of COVID, people tend to do more digital investments. Now, as a testament to that trend, the revenue of Grow grew by about 14x last year. They also became profitable. Satya Nadella, of course, the CEO of Microsoft, joined Grow as an investor and advisor. And Satya Nadella joins very few startups as an advisor. So the premises that we are acquiring will be the headquarters of Grow, and it will be the registered corporate head office. What we always try to do for our investors is enter, at very distressed valuations. Even in this case, we got a third-party valuation report done. We are significantly under market. The valuation report implies a 48% discount to market rate. Again, so as mentioned before, what we do with this discount is a large part of the discount is realized by our investors, but we also pass on a benefit to it to our tenants so that they remain happy and with us for a long period of time. So, the rental is 60 rupees, which is significantly below market, and which is why SmartWorks has given us a 9-year lease with a 5-year lock-in, terms that otherwise in COVID are unheard of. In our current opportunity, the kind of rental that you'll see as an investor, it starts off at 8.7%, again, something very, very competitive. And, it averages off at 9% across 9 years. Again, this increase in rental is something that is recorded in the lease agreement, which is a binding registered document, between the tenant and us. Unlike most wealth products, which have, quarterly payout, or even fixed income products that have bi-yearly or annual payout, investment, returns from products like this give you monthly cash flow. So our rental distribution is monthly. This is a basic sensitivity analysis. So, what we are projecting right now is an IRR of 16.2% with an MOIC of 3x. So that's a multiple of invested capital of 3x. Even if we go to the most conservative side of the table, the minimum IRR that we can expect is a 12.3%, which in our opinion, is very, very achievable. Some of the appreciation drivers that we've spoken about previously include that this is a platinum rated asset, something which never comes onto market. It's a brand new building with a brand new lease. So this is not an old lease whereby the tenant wasn't aware of the pandemic or wasn't aware of the kind of repercussions of a post-pandemic world. The discount from market rental is about 48%, which is captured in a valuation report that we get done from a independent IPC, usually a Fortune 500 company, so that is very credible and entirely transparent price discovery. Blue chip tenant and proximity to metro stations. So Bangalore as a city has a lot of metro stations that are coming up. This property is very strategically situated on Outer Ring Road, adjacent to 2 metro stations. Outer Ring Road as a micro market has been the largest IT corridor of Bangalore, if not the country, and it's maintained a 0% vacancy rate. It's the only micro market in the entire country that has maintained a 0% vacancy rate. So that's predominantly the reason we are very excited about this opportunity going forward. Now a little bit about how this entire opportunity is structured for an investor. So I'll start off by talking about the SPV. So SPV is a special purpose vehicle. So in our case, it's a private limited company which gives that investors the much needed security and safety. The private limited company goes out and buys the property. The rents are paid to the private limited company, and the investors become proportional shareholders and security holders of the private limited company. So let's assume that an investor basically wants to invest 50 lakh rupees. He will get allotted 50 lakh rupees of securities from the private limited company that owns the property, and the rentals will flow proportionately month on month. Myre manages the property, the SPV, as well as the investors. So we do everything end to end. We make it an entirely seamless process whereby all the operational overhead is done by our team. So Myre as an organization, we've been recognized and we've got a lot of publication visibility due to the kind of work that we've done, due to the kind of asset class that we're opening up for investors. We've seen investments from 16 plus different cities in the last 1 year, from all kinds of individuals. We've closed some flagship assets. I mean, Magarpatta as a development, for those of you who are familiar with Pune, this is the most marquee development in Pune. In fact, there's a Harvard Business School case study about it. The other landlords in this development include your Max Life Insurance, PNB MetLife. So, bringing this kind of asset to retail investors for the first time with unprecedented kind of access, that's something which has truly caught traction. This is a certificate we got recently awarded as the Prop Tech Platform of the Year award, and a lot more publications. So raising this awareness has enabled us to create this category and be a leader in the space. Great. So that was regarding our platform, regarding our current opportunity. So Kamal, we can open it up to questions if people have.
Sure, Aryaman. So you can kindly stop the presentation. It is very interesting and I think very insightful to go through all the slides. But one question which I think or everyone who is logged in is wanting to ask is the how does the regulatory framework work?
Absolutely.
Around this, because unfortunately the foremost aspect which comes to any investor's mind when he thinks of any alternative investment is risk. So please share your views on it.
So, what we are following as an underlying framework is something which is governed by the Companies Act. So the process is called private placement. So, private placement is a structured process, again prescribed and outlined in the Companies Act, whereby, a consortium of investors can come together and undertake an investment in any field for that matter. In this case, it's real estate, but you can do private placement for any form of alternative investment avenues. So to that extent, this entire process comes under the purview of the ROC, of MCA and of Companies Act. And we are complying with all those regulatory requirements, and all documents in line with the same are provided to investors, in real time on an ongoing basis. Effectively, what an investor is getting from us is shareholding and debentures. So again, these are very traditional kind of products, nothing very experimental.
And what is the kind of liquidity that one gets today? Because it is fractional, one is getting access to the platinum property that you mentioned. I would also want to understand what do you mean by platinum, and what are the other categories? How is gold, for example, different from platinum? But within that, do also cover that what is the kind of liquidity that one is able to get once the investment is done.
Sure. So, these ratings, platinum, gold, silver, and bronze, these standards came to India about 7 to 10 years ago. The reason for the introduction of the standard was to distinguish your A-grade assets from the remaining lot. There are two standards that have become popular. One is LEEDs and the second is IGBC. Both are national and internationally recognized metrics. So, becoming a platinum rated asset, you pretty much have to check every box in the, in the sheet. You can't leave out anything. A gold, yes, will meet a few lesser criteria and so on and so forth. So usually a platinum rated asset, what it implies is that this is a remarkably good building. It has very, very good construction quality. It will, age very well with time. It won't start deteriorating. But most importantly, as buildings age, your capex outflow in maintaining that building, your utility expenses, your common area maintenance, all these expenses keep increasing exponentially. In a platinum rated building, it tends to be constant with time. So, that's one of the biggest USPs for such an asset. Now, with respect to the other part of the question, which was the liquidity. So, I'll discuss this in twofold. The first is that, this is a yielding product. So in some senses, you can compare it to, let's say, an NCD. So, there is a mark-to-market gain in NCD when the yield goes up or when the interest rates go down. Similarly, in real estate, rentals escalate with time. So today, let's say the yield is 8%. With the contractual escalation, after 2 years, it will be, let's say, 9%. So at that point in time, mark-to-market gain can also be made in terms of liquidity. But now I'll address the, how easy is this liquidity and how easy is it to realize the mark-to-market gain. So effectively, because there's a rental income cash flow, that's why it becomes a form of a wealth product. So what we've noticed is that people are far more comfortable of this form of real estate, and we've seen very large retail traction. Today on our platform, we have, like I mentioned, 15,000 users. We are targeting this year to end with about 75,000. So tomorrow, let's say, even 10 investors, 30 investors want liquidity at 25 lakhs. We have enough pipeline of retail investors who, number one, are familiar with the concept, and number two, are comfortable with this whole investment structure. So, they very easily come and substitute. Now, that is regarding the future, but what has happened already in terms of track record and liquidity? We had a couple of cases where certain investors, for personal reasons, wanted liquidity. In all cases, existing investors of that opportunity ended up acquiring that stake. So, people tend to be happy with their investment. Things are going as according to plan, if not better. We always remain on the conservative side. So, we are able to deliver more than, what we commit. So, people are very happy. Therefore, nothing has really gone out of the, pool of existing investors. But in terms of liquidity, we've been able to so far, of course, fill all liquidation requests in under 1 week. It's not a challenge. We also oversubscribe assets as we discussed earlier in the presentation. So we have a wait list of almost the same value of the asset value. So, even they are more than willing to sort of substitute any investor that wants an exit.
How are you, accessing all these class of investors, like 15,000 investors, and you're targeting to reach 75,000 investors? So today, for example, on this call, we have around 100 investors who are logged in. But 75,000 is a very, very big, tall number, and you have already reached 15,000 investors. I have not seen any marketing or any, content or article written about Myre Capital. But, please explain, how have you actually reached 15,000 investors? Because this is coming, I myself coming from this industry, number of 15,000 investors is actually pretty large for an alternative asset.
Sure.
Yeah.
So coming to that, I'll tell you what we did incorrectly first, which will give insight into how we reached 15,000. So initially, when we launched our platform, we were following the traditional way of attracting investors, which is your digital marketing, paid ads, and that only gets you so far, and it has a cost associated to it. What we realized, 3-4 months into operations is that, or well, into the ad journey, is that what is far more effective and what is pertinent to build this category is raising awareness, educating investors about a safe way of investing into real estate. Real estate is something which we don't have to convince people on. Indians love real estate, Indians love rental income. What we have to raise awareness about is how to do it safely. So, to that end, we've done a lot of webinars, we've done a lot of write-ups, we do a lot of publication, knowledge-based articles, and we're constantly talking about this space. So more than you can say, paid ads or digital ads, we focused on content first, lead acquisition. So that's something which has worked phenomenally well. And usually, what happens is, I'll give you an example. We have MD of Deloitte, who invested with us. Now he was very happy with his investment. He went and told all his colleagues. So it has a ripple effect, especially a product like this. So from that one lead, we were able to generate 200 leads. Now it's a different story how many of those converted, but now 200 more people know about this concept. So that's how we've been able to increase our base so quickly, because we work with our investors to try and build this category up. It's we don't try doing it independently. Our brand ambassadors are our investors.
Sure. So we have built this platform PMSAF World exactly for doing knowledge conversations, and we have backed this by a lot of analytics, very fine analytics and content, and that itself has given us a lot of clients and a lot of business over the last 3 years. So I can definitely understand that how contributing to the ecosystem by trying to educate investors, one is able to actually grow one's own client base, and that yes, that client base becomes your brand ambassadors. Absolutely, I can understand. But yes, 15,000 was a very large number, because while we have been doing the last 3 years, we have grown to around 400 clients, but ours are large clients. So 15,000 is a very large number.
Correct. And Kamal, just to add on to that, I'll tell you, two minor points also. So one is that, someone with 25 lakh rupees today, he cannot go to an EIF, the threshold has been increased. He cannot go to a PMS, the threshold has been increased. So, how does he access, what does he do with his 25 lakhs? So, this is a solution to that as well. Fixed income as a space died in the pandemic. FD is 5%, no one is going to invest in. So, all of them are looking for alternatives. In the pandemic, people focused a lot more on their portfolios. So, that also gave us a push. But something that we did differently, and something that we've uniformly heard as a positive review, is that we have skin in the game. Most people tell us that because our money is where, effectively our mouth is, they are far more comfortable coming alongside us. Usually in funds, what happens is, as a fund manager, he charges a specific fee. Now, theoretically, a good fund manager will insure his fund as well, but at the end of the day, for him, his incentive is not interlinked with fund performance. To most of it, neither is his risk. In our case, we put the money in, and we also match the largest investor. So we have as much exposure as anyone else in any opportunity that we present.
Right. No, I can understand. What is the fee structure, from investor perspective, or various types of fee structures that you offer?
Sure. So, in what we follow is a 1 and 20 model. It's a 1% management fee. Again, this is not an unrealized appreciation. We charge it on the base asset value. So, if you invest 25 lakhs, we charge 25,000 rupees a year. And this is deducted from your rental income. So, when you're telling you you're 7.5%, 8%, this is post-hour fees. So, there's no hidden charges per se. But more importantly, let's assume that tomorrow there's no rental income coming in, then we are also not entitled to any fee. So, we only charge fee for the time where we deliver. And in terms of performance fee, we only charge it above a hurdle rate of 12% IRR. So, up to 12%, we earn nothing. Only the surplus income above 12%, we charge a 20% profit sharing. So, our intent is that we want to do this on volume. We don't want to try and squeeze the returns down for investors, because at the end of the day, like I mentioned, it's a symbiotic relationship with our investors. They have to be comfortable with the returns, and we have to try and do volumes, thereby enabling a lower fee, entire module for this kind of platform. For our current opportunity in Bangalore, this is the first of its kind, because getting an asset in Bangalore is difficult. So we wanted to encourage investors. We wanted to build our base in Bangalore. We reduced the fee to 50%. So in this current opportunity, we are only charging a fee of 0.5%, a year. So using tech by lowering our overheads, we've been able to pass on that benefit to investors in the form of a lower fee.
For the property that you mentioned, the commercial property for which you're raising money in form of fractional investment, you have kept minimum investment as 25 lakhs. Or the investment was always minimum as 25 lakhs for all the investors that you acquired, because 15,000 investors into 25 lakhs obviously makes it very large number. So there is a gentleman over chat who has asked this question. So kindly clarify that what do what was the average investment? Yeah.
Sure. So, I'll just actually first give a quick clarification. I think, so 15,000 investors, when I'm mentioning, those are 15,000 registered and KYC users on our platform. So these are not necessarily someone who's given us 25 lakh rupees yet, but these are people who've, gone through the entire KYC phase. They spend half an hour effectively building their profile on our platform. So they are people with intent. In terms of our converted investor base, yes, you can roughly take 150 crores divided by 25 lakhs, and those are the converted investors, because that's the amount of supply we've had. Now, quite often, because people, the kind of demand that there is, they don't get a chance because of the wait list. We've retained a 25 lakh rupee minimum through and through currently, but we are looking at, maybe increasing it marginally or decreasing it in the future basis the feedback we get from our investors. So, we keep changing the specifics of the structure as and when we keep receiving that kind of feedback.
Sure. So investors, are always worried about taxation also. So this is the last question that you need to address. That how does taxation work, and what is the kind of post-tax, post-expense return, and what component of return would be coming in form of a accrual or a recurring income, and what component could be expected, at the time of maturity or at the time of one redeeming one's investment.
Sure. So I'll start with the major part of the return, which is capital appreciation. So that of course comes when you exit your stake or when the property is exited. It's only realized then, even though we show unrealized appreciation basis annual valuation reports, but of course it's only realized at the end. Now, in terms of taxation, it's very favorable. You get indexation benefit, of course, compounded annually, and you get the benefit of LTCG. So, that reduces the effective tax rate quite significantly on any appreciation. And, well, just to give a numeric example, if we catch a 4-5% indexation rate a year, 4-5% a year in appreciation is entirely tax-free. Now, above and beyond that, you'll still get indexation benefits. So, it works out to a 10 to 15% effective tax rate on your appreciation. Now, the other part of the return profile is the rental income. And what we've done is we've created a pass-through structure. So all the rental flows directly to the investor, and he can optimize it in his hands. So just in terms of optimization, what we've seen are a couple of things. So people above a 30% tax slab rate, they tend to invest via private limited. Thereby their taxation is limited to 25% being the corporate tax rate. People are investing from HUF, of course, because of the tax benefits. People tend to invest from their family members' name, like their retired parents, their children who might not have a taxable income. So, this makes it very, very attractive. Getting 8% post-tax is a phenomenal return. So, that's another kind of optimization we observe. And NRIs rarely have an income in India or a high, tax rate in India with respect to income. So for them, this is a fantastic solution. They're getting 8%, more often than not tax-free.
So if investors who already have physical real estate and they kind of think of liquidating, say, one of their properties, and again reinvest that with you in your fund, will the capital gain from the existing property kind of adjusted? This investment will be considered from that perspective as a second real estate investment within the period to kind of avoid capital gain taxes?
Sure. So in terms of reinvestment, what the investors are effectively getting as security are equity shares. So, the reinvestment is not viable because even though the underlying asset is real estate, but effectively the ownership is of equity shares and debentures. So, for that reason, it's not possible. But let's assume even if they were to do it themselves, reinvesting from commercial to commercial, you don't get that benefit. You get that benefit when you redeploy capital gains into residential property. Now, residential property, the reason you also get this benefit is because historically the returns have been 1 to 2% in rental yield. So, even if you reinvest and save that little bit of taxation, it might not be the best idea, to anyways do that.
Right. I would ask, this question, the very, very first question once again, and I'll tell you this is the last question. Any other risks that you kind of, want to highlight from investors' perspective who think of doing the fractional real estate investment?
Sure. So, real estate comes in many shapes and forms. It comes in under construction, it comes in post construction, vacant, leased, brownfield, greenfield. However, as a platform, what we've done is currently we are focusing on core and stable assets. So, all the properties, number one, are institutional grade. They have institutional investors. Number two, there's no development risk. So, all these properties are completed. There's a OC, title certificate. Everything is in line with the completed property. And thirdly, we ensure that we have a tenant in place with a fresh agreement. So, there's also no vacancy risk or loss of rental risk for the considerable future, 9 to 15 years. So, to that end, I'll put it another way. If a real estate investor was to enter real estate, their expectation of return would be 18-20%, but that would be commensurate with under construction risk. In this case, your risk is also much lesser, but your returns are also 8-10%. So, 8 to 10% is a strong proposition in the wealth space, but when you take it to benchmarking it under construction real estate space, it's there's a clear cut difference. So in the future, we might get into under construction. Again, we are taking it in a very, very we're looking at it, but in a very conservative manner. Under construction is tainted in this country, and we don't like third party risk. For that reason, we have not ventured into that field. But if we do get into under construction, then you'll see returns being 18-20%. So, it's always a risk return balance. And in this case, the risks are effectively what, I'm having.
Right, Aryaman. So it has been really pleasure conversing with you. To everyone here who participated today, I would just like to tell you that PMSAF World has been doing really good work in terms of providing you knowledge-backed, analytics-driven investment products. And in that regards, we have deep dived Myre Capital. I have personally conversed with Aryaman, at length. And I would like to tell you that this is a very good option for anyone, who's wanting to make informed investment and a good substitute to, you can say, a debt and equity. And that is why it is an alternative asset. Thank you everyone for joining us today. And thank you, Aryaman, once again.
Yeah, thanks. Thank you, Kamal. Fantastic platform and, really nice interview. Thanks for your time.
Pleasure.